So I want to talk about income replacement and the need for you to understand it. My name is Yemisi Legushe, okay? And the topic today is understand income replacement options in Canada. Yes, I'm a licensed financial security advisor. Financial advice is going to vary from person to person, especially when it comes to your retirement, your investment options, and your risk tolerance. Are you someone that you are low risk, you don't like to take risk with money? Then the type of investment plans for you is going to be different from someone that is ready to take risk. The higher the risk, the higher the return. That is what happens with investing. The higher the risk, the higher the return. Low risk, low return. And we are all different. Some of us we can take risk. And in fact, without risk, we are not living. So you are going to determine the type of risk that you can take. Right. So permit me to share this with you. Regardless of your current age, whether you are 20, 25, whether you are 30, 35, 40, 45, it is good to plan for retirement. And my job as a licensed financial security advisor is to plan you for the future. Yes, some people will say the future will sort itself out. It doesn't happen like that on a normal day, right? Most of us, before we came to Canada, it took us like 5 years planning, 2 years planning. So your retirement is like 9,125 days. So what are you doing right now to make those years a good one, to make it to make it days that you are comfortable, to make it days that you have financial peace of mind? You need to start now. So take a look at this. You want to retire at 65, or do you want to retire at 60? If that is the goal, what are you doing currently to actually help you to achieve the objective of retiring at 60 and to be financially stable? Are you looking at retiring in the next 10 years? Guess what? If you're someone currently in your 50s and you already have a house, you fully paid for your mortgage, that mortgage can actually be one of your retirement plan because it has built up equity and you have access to do home equity line of credit, or you can do reverse mortgage. But you need somebody to explain both options, and then you decide the type of option you want to use to actually leverage and use the equity on your house. There is a particular formula that you would not know in the financial sector except somebody like me tells you. There is something that is called Rule of 72. It tells you the number of years it will take for your investment to double, or the number of years it will take for your debt to double. You owe on your credit card 50,000, $5,000 debt, you do not pay it. That debt is going to multiply rapidly because of the fact that most credit cards are going to charge you like 25 to 30% interest on that credit card debt. So I always like to call it the credit card debt is the most expensive loan that you are going to take. They charge you like 25%, 30%. Meanwhile, when you do mortgage, they only charge you like 5% or 4.5 or 3.9, whatever the case is. Even if you buy a brand new car, the interest is like 4 or 5%. But when you owe on your credit card, it is an unsecured debt. So they have the liberty to actually charge you 30%, 20% interest on these loans when you do not pay it back on time. So would it make sense? You are investing, your investment in a financial institution is giving you 2%, 4%, but your credit card loan is charging you like 20, 25. It doesn't make much maths. You have to do this. Pay off your credit card debt because it doesn't help you in any way. You do not look important, you do not look smart when you have a lot of credit card debt and you are investing. You also need to do it at the same time. Reduce your credit card debt by paying it off as much as you can and as rapidly as you can. And then when you invest, your investment can actually build up interest, right? May we all eat the fruit of our labor. That is why you want to plan to retire early. My question for you today is, let's assume you have 300,000 in a taxable account, right? And you're paying 11% withdrawal taxes. How long will that money last? How long will it last? So my question is, Jane Doe, you are 65-year-old today and you have $300,000 in your taxable account. You are subject, for example, 11% withdrawal tax. How long will that money last? The question is to let you know that your money might run out, and you are still someone that wants to enjoy retirement. So you need to create different sources of retirement plans for yourself, right? Because if you depend on just only one type of retirement plan and it runs out, you don't want to be a 72-year-old that wants to go back to start working, right? The strength is no longer there. It is good to actually understand how money works and the different investment options that can help you. Knowledge is power. We don't want our money to be destroyed because of lack of understanding, or we don't want our peace of mind to be destroyed because of lack of financial knowledge regarding Canadian investment options. Now, there are investment options that are tax deductible. Top on the list is RRSP, and the second one is FHSA, First Home Savings Account. If you have never bought a house and you intend to buy a house in the next um, couple of months, couple of years, or within 1 to 5 years, if that is your timeline, it is good that you set up the FHSA, First Home Savings Account. While the benefit is when you pump in money into the FHSA based on the maximum contribution limit, you can declare it for income taxes. That can reduce your taxable income, and then you might even be lucky enough to get tax refund, right? And there are some investment that are tax free, and there are some investment that are tax deferred. RRSP is a good investment, but I would like to tell my client that RRSP is good. When you invest in your RRSP and you get tax refund, are you going to reinvest that tax refund, or you're going to spend it? Because this same RRSP that is tax deductible now, you enjoy the tax refund, you are still going to pay taxes in the future. And there's a school of thought that says, well, your taxes on your RRSP in the future is going to be lower. It is true, but it's not true for everybody. If you are 65 and above, and your total world income is high than a certain threshold, your marginal taxes are going to be high too. So that statement that your RRSP is going to be taxed at a lower rate when you retire is true, but it's not true for everybody. Guess what? You have to invest your money such that your money works for you and you want to maximize tax-free benefit. That reminds me, your TFSA is an investment account. Open it, invest it. When you have your TFSA, it can be invested in high interest savings accounts, GIC, bonds, shares. You can invest it in segregated funds. If you want to know the difference and how this can help you grow your TFSA, RRSP, or FHSA at 4 to 10 or 15%, then you want to book a free session with me, right? Now, there are different types of loans. There are some good loans and there are some bad loans, and you want to be uh, informed about this. Okay, so your savings account is a good account, but the interest in a normal savings account or a standard savings account is taxable. And that is why you have your tax-free savings account. Because of what I do, I have met people that have checking account, savings account, but they don't have tax-free savings account. Tax-free savings account, your money and the interest is tax-free to you. So you want to do yourself a lot of benefit by opening your TFSA and invest your TFSA, because the interest or the dividend that you get from that, it is tax free. Now, there are good loans, bad loans, and collateral loan. Now, most of the time, buying a house, you don't have the $800,000 or 1 million, and then what do? You get a loan from a financial institution. Guess what? Your credit card management skill is very important. You need your credit card, you need to use it because it describes who you are, and your credit report and your credit score has a way of affecting the way you are going to be treated when you want to get a loan, or when you want to get a mortgage loan, or you want to get a car loan. So you want to make sure that at least you work such that you work towards building your credit score such that your credit score is between or above 650. That is my advice for you, okay? Now, one of the things that is overlooked by professionals is, God forbid, I will not be sick. God forbid, it will not happen to me. But the truth that has to be told is, health is wealth. Do your annual checkup, because health can actually affect your income. When someone is sick, it affects their income. And once the income is affected, the lifestyle is affected, your family is affected, it creates a lot of financial stress. If peradventure your family, your mother, your father, siblings had a form of critical illness, stroke, cancer, multiple sclerosis, major organ transplant, I advise you to get what is called income protection plan. We one on top of the list we have critical illness insurance, and the benefit of critical illness insurance is that you get a refund of your money if you don't use that policy. Yes, I wish you above all things that you prosper and be in health even as your soul prospereth. We all want to prosper. We all want to earn that six figure. But the house that you have bought is not your most valuable asset. Your most valuable asset is your life and is your income. Your most valuable asset is the ability to work. Your most valuable asset is your life. So you want to protect your income. God forbid you are not able to work for 6 months because of a sickness or an injury. How will you pay your bills? Yes, my black community will say, God forbid, it's not going to happen to me. You are supposed to learn from people that it has happened to. Peradventure, you do not know. This year alone, I have had the unfortunate case where I had to discuss with two ladies. Currently, they are battling with cancer, and I pray that they survive it. They are taking chemotherapy, and their finances are affected. And I was using this opportunity to advise people around them that, see, we always pray that these things do not happen. But guess what? Set up your critical illness insurance. If you use it, fine. God answers prayer, you get healed. God answers prayer, you don't even develop a critical illness, cancer or stroke or heart attack. You can get refund of your money. So your money is not gone. You can actually get that money back. The premium you paid for your critical illness insurance, you can get it back. And guess what? It gives you the peace of mind during that most challenging period. You don't want to be a burden to your kids or your burden to your partner because it actually affects everybody. Now, why is income protection plan important? You want to protect your most valuable asset, which is your income. If anyone is sick in the hospital currently, whatever condition they are, whether it's cancer, whether it's heart attack, stroke, and they are between life and death or they are intensive care unit, the issue is that same person has bills to pay. If somebody is in intensive care unit for 1 month, 2 months, God forbid, the person still has bills to pay. The bills will not go away. Mr. Bill is a very, very not nice guy. The bills will not go away, right? So it's important that you set up income replacement plans such as critical illness. Disability insurance is an insurance that will pay you, God forbid there's a disability, and it pays you 60 to 80% of your pre-disability income. Critical illness means critical illness insurance, God forbid you are diagnosed of a critical illness. We have 25 list of critical illness, okay? Cancer, stroke, heart attack, multiple sclerosis, we have a long list. So if peradventure your parents had such situations in the past, I always advise you to get critical illness insurance because you are able to get your money back. God blesses you with good health, you don't use it, you get your money back. And guess what? You have also peace of mind when you have a life insurance policy that can pay you compassionate benefits. God forbid there is a terminal illness, right? Terminal illness benefit is one of the reasons why you need life insurance even at age 65 or 70 or 75. Compassionate benefit or accelerated death benefit can give you between 50 to $250,000 from your life insurance. God forbid you are diagnosed with a terminal illness. And God has always answered prayer. Some people will be diagnosed with terminal illness and eventually they don't pass away. But during that challenging period, they still need money so they can have access to compassionate benefit during that period, right? And they are not financially stressed. They focus on getting well. We have different types of financial protection tools. So I always ask my some of my clients this question. You have $50,000 you want to invest in TFSA, RRSP, FHSA. Wonderful. And I advise you on the portfolios to set up, and then we do the application for your TFSA. And I'll be like, I have a question to ask you. If you invest today and life happens tomorrow, you gain admission to heaven, what happens to your loved ones? And they will go blank. I said, I'm sorry, the nature of my job is not that easy, but I have to tell you the fact. You need to understand that your life insurance policy is as important to you and your family, because life can happen to anybody and it takes 1 minute. It takes 1 minute for life to go, right? So that is the reason why you should consider setting up your life insurance. And you can set up your life insurance based on your budget. Canada is a country where the system works. You set up your life insurance policy, the benefit goes tax free to your family. Imagine you are 80 and you have a life insurance of 2 million. At age 80, you are still a blessing to your generation. You are still a blessing to your family because $2 million goes to your family tax free. But you have to set up the life insurance when you are young. You're 25, you're 20. Set up the life insurance when you are young. Why? Why will I tell a guy or a lady that is 25 or 28-year-old to set up their life insurance? When is the best time to buy a house? Is it when the interest rate is down? You're going to buy a house when the interest rate is down. The Bank of Canada says the interest rate is like 1%, 2%. People want to buy houses then. So the reason why you want to set up your life insurance when you are young, you are healthy, is because the rate is actually very cheap at that time. It's very cheap at that time. You do not want to be someone that is 50, 55. You now realize the benefit of life insurance, but it is extremely expensive at that age. But the fun part why I know people delay setting up life insurance is they think they can get it at any time they want. No, life insurance is not like a bag of milk or a bar of butter that you go to Walmart to pick up at any time. You have to set up life insurance when you are healthy. Insurance companies reject people when they have health challenges. So there are some companies that will offer what is called guarantee life insurance, but those ones are expensive. So the issue with life insurance is you have to get it before you need it. By the time you're desperately looking for it, maybe because of a sickness or an injury, it's already too expensive, right? Excuse me. So there are three ways to get refund of your critical illness insurance benefit. Refund payable to your beneficiaries, God forbid death happens before you got your claim, or the plan has expired, you did not use it, you can get refund of your money. And during the period that you set up your um critical illness insurance, you can get your money back. Okay, for example, let's say you are a 30 and you did critical illness insurance for a coverage of $50,000. This gives you an example. You are female, 30-year-old. You did set up critical illness insurance from age 30 to age 75. That is 45 years. And you pay $64.04 monthly. You do that for 20 years. The total amount you have paid during that 20 years is approximately 15,369. Guess what? If peradventure life happens during that period, you do not claim that benefit, or you do not claim the critical illness insurance of $50,000, your beneficiaries on that policy get that 15,369. So your money was not wasted. The second option is the plan has expired, you get a refund of your money, right? You did set up critical illness from age 30 to age 75. And God bless you, you are now age 76. You did not use the policy. The total amount of money you have contributed, 19,992. You can request for your refund, right? So feel free to reach out if you have questions, and I hope you learned something today, right? Thank you so much for having me. Have a good afternoon.